We were on vacation once in Norfolk, Virginia. We were on the beach of the Chesapeake Bay, and a storm came rolling in, and I remember a big fish, a big wooden fish, was hanging on the house by these little eyelets, right, that were hanging up. And the wind had blown one of those off, and so the fish was dangling by one of those eyelets, and the wind was just smacking it against the house. And guess who got to go out and wrestle that fish and prepare it so that the wind wouldn't use it to destroy the house? Well, guess what? The winds are getting pretty violent in the market these days, and it's time for us to look around in our portfolio and see if there are these big wooden fish that we need to take down or that we need to do something to protect our portfolio as the winds begin to blow. The Fed has been raising rates pretty quickly. And I get it. You know, they've got a job to do. These rate increases are intended to slow down inflation. Inflation is being pretty stubborn. And so they've got to do their job. They've got to do what they need to do. But they are moving really quickly. And you typically don't see the results of the rate increases for a little while. So there's a lag that's happening, and they don't have visibility into that lag. So it could be concerning, right? We're in a period where we may already be in a recession, or if not, we may see one right around the corner. So it's really time for us to make sure that our portfolios are set up as best as possible for a recession. So if you want to see the assessment and analysis I went through in my portfolio to see if it's recession resistant, stay tuned. Hey guys, Kevin Burgess back again with another video. I'm excited to be with you today. I think we've got an exciting video ahead. You know, transparency is really important to me on this channel. So I share with you everything about my portfolio, and I've always said I would share with you the good, the bad, and the ugly. So today we're going to do two things. We're going to take a look at the portfolio's performance over the past 2 weeks. That's the ugly. And then we're going to take a look at how I looked at everything in the portfolio to determine if there are things that I need to do to batten down the hatches to get ready for this storm that's coming. And as a result, I've identified some positions I may actually trim here in the short term to help better prepare my portfolio for this coming recession. Now, I'm not a financial advisor. I just simply share with you my journey going through this dividend investing process. I'm excited to show you the analysis that I performed on my portfolio to see how well it's prepared. So with that, let's get started. Okay, guys, here it is. This is the portfolio update for the past 2 weeks. You'll notice that I've put the portfolio balance in for September 9th. This was the last time I had updated you guys on the portfolio's performance. So I started from there and put the portfolio balance in for the 23rd, which is a 2-week span. And you can see that we're down $63,905 overall. The cool thing is that over the past 2 weeks, we've gotten in $2,800 and almost $16 in dividends, which is really cool. Also, we've put $100 into the dividend snowball account, which is $50 per week. And you can see that the market change was $66,821 down in the last 2 weeks. Now, this equates to a 7.6% drop. One thing that I will point out, you can see that I have this income account, I have a dividend growth account, and I have a dividend snowball account. All of them are down pretty consistently. So what that tells me is that the market is dropping in general. So there's really no place to hide in the market at this point. You can see that the S&P 500 over that 2-week period is down 9.2%. So we're beating the market at least. You know, we got that going for us by about 1.6%. Now, on a year-to-date basis, we are down about $93,000. And again, $67,000 of that is in the last 2 weeks. So that's a pretty big drop. 2/3 of our drop is in the last 2 weeks. So overall, it is an 11.3% decline in the portfolio on a year-to-date basis compared to the S&P 500, which has dropped 23% on a year-to-date basis. So our portfolio has dropped less than half of what the S&P 500 has dropped. And then you can also see a total return here where we have dividends and options income, which is about 2.6% of the portfolio. So on a total return basis, we are about 8.7% down for the year. Now, you might be saying, hey, haven't the winds already begun to blow? Hasn't the fish already been beating against the side of the house? I mean, we're down, about 7.6% in 2 weeks. And yeah, the answer is yeah, the winds have already started to blow. But this process we're going through is not about getting out of the market. It's just making sure that we have the right investments to carry us through this period of a recession. So with that, let me take you into the analysis that I did. So before we dive into the details, I want to share with you what criteria I used. I looked for 5 different things in each of the stocks in my portfolio. So first of all, I wanted to see how well prepared or positioned a company is that's in my portfolio to handle the coming slowdown in the economy, a slowdown in revenues, a slowdown in cash flow. So there's 5 things that I looked at, and I could have looked at 100 things, right? But I looked at 5 different things. One is the earnings payout ratio. And for a healthy position going into a recession, I wanted to identify the companies that were paying at a payout ratio of less than 50%. And it's important to understand that sometimes these earnings payout ratios can be manipulated a bit. I showed that to you in a video with Advanced Auto Parts a few weeks ago. So I wanted to also incorporate the free cash flow payout ratio. This is much more difficult to manipulate, and because cash is cash, right? If the cash is coming in, then it shows up in the ratio. I also wanted to see which companies had a free cash flow payout ratio less than 50%. Debt might become a big issue. So I wanted to identify companies that had net debt as a percentage of total capital less than 25%. So that means that about 75% of their total capital is funded by equity, and about 25% or less is funded by debt. I also then wanted to look at the return on invested capital. So this tells me really how efficiently a business can convert its capital into earnings. And so I wanted those that were greater than 15%. So I picked 15% because I wanted to pick a number that would be above most companies' weighted average cost of capital. Then the last thing I put in here is the Simply Safe dividend rating. I identified whether they are very high, which is greater than 80, so 80 to 99, and then high, which would be 70 to 80. Now, there's some caveats to this. First of all, this only shows the financial health of the portfolio, of the companies in the portfolio. It is not suggesting that I should either add or remove shares of these companies. It also helps identify companies that can withstand a recession, but it does not predict what the market returns will be for these companies during a recession. This is strictly a health assessment for the companies that are in my portfolio. So these 5 criteria, there are going to be companies who met all 5 of them, and I've put them in, having met all 5 criteria. Some will have met 4 of the 5, some 3 of the 5, some 2 of the 5. So I'm going to show you a slide for companies that met 5 of the 5 criteria, that met 4 of the 5, 3 of the 5. So we'll kind of walk through them in that order. So the companies that met 5 out of 5 that are in my portfolio are EOG Resources, Microsoft, Robert Half International, and T. Rowe Price. And as you know, if you've watched my videos, I've recently added T. Rowe Price and Robert Half to the portfolio. I also added in here the percentage of the portfolio that it is. So for instance, EOG Resources is 2.8% of my portfolio. When I look at Microsoft, it's 4.5%. So the companies that met all 5 criteria are about 9% of my portfolio. Obviously, there's nothing I need to do here with these companies. So now let's move on to the ones that met 4 of the 5 criteria. You can see this is a pretty big list. It's actually 38% of my portfolio. So I will let you read the names down here on the side rather than just reading them to you. But there's a couple of I've highlighted here. One is Best Buy, the other is Whirlpool. So just to point out why I've highlighted Best Buy and Whirlpool, the numbers that I looked at were the most recent 10K numbers that have audited financial statements. But I did take a look at what was going on in the quarters after the 10K was issued. And in both Best Buy and Whirlpool, they are seeing some struggle around their free cash flow. This is expected in the market that we're dealing with right now. So I'm not concerned about them, but I did want to mark them and make sure that I pay close attention to Best Buy and Whirlpool moving forward. Now, the companies that met 3 of the 5 criteria were Cummins, General Dynamics, Hess Midstream, Parker Hannifin, and Prudential. This is about 16.8% of my portfolio. I'm comfortable with all of these companies. I do plan to trim Hess Midstream though moving forward. It's only 1.5% of my portfolio. I also want to take a deeper look into Cummins just to make sure that they are prepared. And as you recall, I have trimmed some of Cummins. I think it was right at 10% of my portfolio at one time. And so it's now 8.2% of the portfolio. So I have actually trimmed it. May take a look at trimming a little bit more. I wouldn't get out of Cummins, but I may trim the position a bit. Let's look at those companies that met 2 of the 5 criteria. So I'm not going to go through all of these companies, but one that kind of causes me to pause is Air Products and Chemicals. I did notice that their earnings payout ratio as well as their free cash flow ratio were above the criteria, as well as their return on invested capital being lower than what the criteria were. So I want to take a look at Air Products and Chemicals and see if it's something that I need to be trimming. And I know that a lot of you will look at Verizon and wonder why I wouldn't trim that. And as we get past this 5G expenditure for Verizon, I think we'll see their free cash flow payout ratio get better. So I'm not too concerned about Verizon at this point. Plus, even in a recession, their product is going to be needed. So not overly concerned with them. Now we're getting into the meat of this, where there's only 1 of the 5 criteria met. Now, 2 of these 4 companies are Philip Morris and Altria Group. I consider them really the same company. One is U.S. based, being Altria Group, and the other is international, being Philip Morris. And given their product line, I'm not too concerned about their product. AT&T, I'm not overly concerned. It's only 0.5% of my portfolio anyway, so I'm not going to do anything with that. Now, Pinnacle West is also a utility. We know that they've had some rough times lately. They're 3.5% of my portfolio. I may look at trimming some of that if we get any strength, but I'm pretty comfortable with Pinnacle West as well. Now, lastly, these 3 companies did not meet any of the 5 criteria. One is IBM, the other is Kinder Morgan, which is a pipeline company, and Main Street Capital Corp, which is a business development company. I would not expect Main Street Capital to meet these criteria because they are a business development company with rules around how much of their cash flow they have to pay back out to investors. So I wouldn't expect them to meet these. I am comfortable, though, looking at historical recessions and Main Street's performance in those historical recessions. So I'm most likely going to hold on to Main Street Capital, not trim that. I may look further into trimming some of IBM. It is 4.5% of my portfolio. I may trim some of that back. I certainly would not get rid of all of it. And then Kinder Morgan, I may actually work on exiting that position. So this analysis got me to the place where I'm going to look at 5 of the stocks in my portfolio. These make up about 20% of my portfolio, so about 1/5 of the portfolio. It's going to be Air Products, Pinnacle West, IBM, KMI, and possibly even Cummins. And again, the purpose is not necessarily to liquidate these positions, but maybe to trim them back a little bit and move the funds that I trim from those positions into companies that are better able to handle recessions that are coming. So hopefully you found some value in this. I know I have for my portfolio, so I wanted to share it with you. So if you found this beneficial, if you wouldn't mind clicking that like button, and if you're not a subscriber, I would love to have you along for the journey. If you click the subscribe button and click the bell, then you'll get notifications every time I put a video out. So one of the things you could help me with is, I looked at 5 criteria. Were there other criteria that I should have looked at? So if you've got any ideas on any criteria I should add to the process, please leave me a note in the comments below. I'd love to hear from you. And with that, I'm going to get out of your hair, and I'll see you on the next video.